Good evening, everyone. Good morning and good afternoon, wherever anyone is. I would like to welcome everyone to Minds and Money's panel discussion on geopolitics and their impact upon commodity demand. 1 month since the US election, a US-China trade war still raging, and the world in the middle of its deepest recession for 90 years. What is the outlook for the mining industry and natural resource investors? First, I'd like to introduce the panelists. And then jump into the questions with a brief summary at the end. So let me start with Shaun Usmar. Many of you know Shaun, who's an international mining executive for 25 plus years of experience working around the globe in operational, financial, and executive leadership positions in some of the world's largest and fastest growing mining companies. Shaun started his career at BHP Billiton, then joined Xstrata, and Shaun served as Senior Executive VP and CFO of Barrick Gold, where he helped restructure the company, repair the balance sheet, and reset the cost structure. In April 2016, Shaun founded Triple Flag with the support of principal shareholder Elliott Management Corporation. In 4 years, you have built a world-class investment team of 13 professionals in 2 offices that has successfully executed 17 transactions, creating the world's largest privately streaming and royalty precious metal business, in 4th largest by asset NAV. You've deployed over 1.7 billion in developing a portfolio of 40 royalties and streams, including 14 producing mines and 1 ramping mine. Outside work, Shaun is director of Make-A-Wish Canada, and Shaun holds a Bachelor of Science in Metallurgy and Materials Engineering from the University of Witwatersrand in South Africa, and an MBA from the Kellogg Graduate School of Management. Welcome, Shaun. It's a pleasure to have you on this panel.
Thanks, good to be here.
The next panelist, Greg Fournier. I'd like to introduce Greg, Managing Director for Asia Pacific of CIBC, Canadian Imperial Bank of Commerce. You joined CIBC in November 2015 and based in Hong Kong. Greg, you're responsible for overseeing the investment banking activities in Asia Pacific with focus on M&A corporate advisory work in the region. And prior to CIBC, Greg was the managing director and head of Asia Pacific Metals and Mining for Bank of America Merrill Lynch. Investment banker for 30 years and working in the exciting world of mining for the last 25 years, M&A, financing, and commodities. You also worked in Toronto and New York. Greg graduated with an MBA from University of Toronto. Welcome, Greg.
Thanks, Carsten.
And then I'll make sure I got this right. Matt Fifield, is that correctly pronounced?
Fifield.
Like to introduce you also. You're a managing partner of Pacific Road, founded in 2006. Pacific Road is a mining-focused investment manager headquartered out of Sydney, Australia. Pacific Road manages 2 institutional private equity funds with a total commitment of 800 million, having made over 20 public and private investments. Pacific Road is focused on control-oriented and active shareholding strategies with substantial potential for long-term cash flow generation. Pacific Road is an industry leader in responsible investment and a signatory to the United Nations Principle for Responsible Investment. As a managing partner of Pacific Road, Matt is involved with all aspects of investment operations. Prior to joining Pacific Road, you had 2 decades of experience building, buying, financing, and selling mines and mining companies. Matt holds an MBA from Wharton and a Bachelor of Geology from Princeton. Grandson of a metallurgist, Matt got his start in mining as a geology field hand during college. So pleasure to have you with us here, Matt.
Thanks, Carsten.
And then finally, just a few words about myself. I'm a director with Partners in Performance, global management consulting firm, also founded in Sydney a while ago. We are thought partners to mining executives in strategic planning, business transformation, technology, and performance management. Personally, I've driven bottom line operational improvements at mining clients with a combined value of roughly 1 billion and improved the construction of capital projects by 500 million and their NPV by over 3 billion. Prior, I worked at Boston Consulting Group and also served as a director at the Energy Environmental Research Center, where I was responsible for technology commercialization and investment activities. I worked and led clients engagements across the Americas, Europe, CIS, Middle East, Australia, and China. It's one of the pleasures of being in consulting and in mining, getting to see the world. In a prior life, I was a researcher and hold a PhD from Oxford University in physics. So let's just dive into questions right away. And maybe I just start with Shaun. Are we in a recession? What sort of recessions are we in? Is it good or bad for mining and mining investors?
Yeah, it's so difficult to actually conceive of where we're at in my mind right now. You see on the television screen in places, people in cars for miles and miles for food lineups, and just this exacerbation in society of the most vulnerable with this pandemic. You go downtown and things look quite dystopian, certainly in Toronto, and I'm sure it's the same for many of you with these services industries and the hospitality businesses. But at the same time, you look at stock markets hitting record highs. I know a lot of us in businesses or in lines of work where frankly we can work from home. We're not paying for parking, we're saving on insurance, we're not going on holidays, and life is maybe inconvenient, but certainly we haven't seen quite those impacts. So I raise that because I think it's an environment that has some time to play out. We're feeling better about this sort of vaccine, but bear in mind, it wasn't that long ago. Copper was just over $2. And you've seen this incredible rebound. It's over $3.20 or so today. And when I look to your question, as we come out of this sort of COVID environment, I mean, surely we're going to see more stimulus. And I think there's going to be a significant overhang that we're going to be dealing with at the end of this. But I also do think that people are resilient. And I do think that for commodities in general, it does bode well. It looks like a good environment. For our space, looking at precious metals, for example, specifically with all this largesse and a lot of this printing of money and the assistance that governments are providing, that does seem to be intrinsically supportive for precious metals. So I'm really looking forward to, frankly, getting out of my living room at some point. And I think you will see a good effect in 2021 and above. I just don't know if it'll necessarily be significantly aggressive, that recovery.
So Nat or Greg, do you see, as Shaun pointed out, precious metal same direction, or do you see difference in different types of commodities across?
If you look at CIBC's forecast for precious metals, I think we're forecasting gold to average around $2,200–2,300 next year. I think for silver, I think we're talking about $30. So that's certainly a premium to where it's trading in the spot market. And I think that's largely driven by all the fiscal stimulus that we're seeing at the moment, the expectation that interest rates will continue to be low, the uncertainty out there that Shaun has highlighted. That's really hard to know what next year will look like. I think if you look at the global economy, clearly we're in a recession at the moment. I think our forecast for GDP growth in the US for the year is, I think, negative 3.7% or something like that. All major economies, or most major economies, are expected to contract. So clearly it's a recession, but it's not uniform. In Asia, if you look at how China's performing, it's recovered very dramatically from the beginning of the year, where there was a fairly significant contraction in the economy. They've moved back to growth. I think GDP growth in Q3 was around 5%. And for the year, it's expected to be in around 2%, maybe 2.5%. So that's quite a recovery. And we're almost at the end of the year. So if you're looking at GDP forecasts for 2020, it's a bit of looking in the rear view mirror at the moment. Next year, and again, lots of uncertainties, but our economists are forecasting for a pretty strong rebound. I think U.S. growth close to 4%, Chinese growth at 8%. So while we're clearly in a recession that's impacting demand for commodities, its markets tend to be forward-looking. So we've seen big recovery in things like copper, iron ore continues to trade at very strong levels as well. And on precious metals, like I say, our firm is very bullish on the outlook for prices over the next few years.
So Matt, in terms of maybe the Australia factor coming in there as well, how do you see the outlook in particular for a region like Australian coal being currently embargoed by China or any of those type of things? How do you see that implicating the future economy in Australia, and then how do you interpret this long term?
Sure, thanks, Carsten. Look, there's a couple things when you step back. The specific question that you asked is, what are the impacts of differentiated Chinese tariffs and prohibitions on certain materials coming from Chinese markets, from Australian exports into Chinese markets? It's pretty clear that has a unsettling and negative effect on the Australian economy. There's a huge export economy. The great things that we do in Australia are we export materials to a growing world, and we have a very vibrant financial services and growing technology sector as well. So, the uncertainty, it makes it harder around capital formation. It makes it harder around, medium-term investment levels. And that's something that, that's a pretty obvious set of things to look at. When you step back, though, to think about a worldview, one of the unknown questions that we're wrestling with right now is what shape is further stimulus going to take, and how is that going to play out in the different sectors? So let's retract. We went through a very bruising period for all economies, all consumers, all savers, all people. And right now, the world, our portfolio companies, the stock markets are telling us that the world is going to continue and things are going to be okay. And the quarter-on-quarter growth from such a low nadir feels terrific. And you see life returning towards that semblance of normality, and that feels directionally correct as well. So there's a lot of positive feelings in the world, and then you have a lot of money in the system at the moment, credit for companies and consumers alike, and that is driving asset pricing, and people's fears of currency debasement, as Shaun was saying earlier about precious metals, is real. The thing that's hard to call right now is if the world economies like China, growing Asia, which are some of the juggernauts in terms of the growth economies, or on a relative basis, US and Europe, if their relative recoveries will cause the 2021 world to feel much more stable around and not need a lot of stimulus. And that's the piece that I think divides, in my mind, the future. We can talk later in the panel about what are the impacts of the stimulus that could come, but I guess our house view is that to date, all of the stimulus has been in reaction to the pandemic for people to feel comfortable staying in their seats, not, whether it's maintaining employment, working from home, and that, we're going to get through this and it's going to be okay. Your governments are going to support you. And the harder policy challenges that people will have, whether it's a Biden administration, targets on growth, are going to be around to what degree is the government going to need to be involved to create that near-term, medium-term future through direct intervention. And my belief is that there will actually be now that governments are in the mix very directly in economies, you will continue to see much more direct interaction with the government and the economy than any other time in my lifetime.
And just going there to the monetary stimulus, will inflation actually be something that will flare up again? We've been seeing basically deflationary pressure across for a long time across basically pretty much every market. Is there something which will swing around similar to what has been seen at different crisis points in the past, where suddenly inflation will come back, like with the oil crisis in the early 70s? Is that something to be thinkable?
If I could take it, there's different types of inflation. Okay,
Yep.
There is consumer price inflation, and even CPI is a slightly untrustworthy index because it excludes important things like food and energy. Yep. And then there's also asset price inflation, and I think we're in a space right now where asset prices are high and continuing to move higher, and some of that, I believe, is a direct result of easy credit and more money in the system. You don't want to be holding cash, so you move to hard assets, or you move into equities or other instruments. So I do think we're seeing asset price inflation right now. In terms of consumer price inflation, that's actually going to be one of the medium-term things that governments are going to have to wrestle with, because there's not particularly wage inflation. There's probably wage compression, right? Yep. Unemployment is high. People are struggling for jobs or struggling to keep people on their payrolls. And so you see wage compression, and governments will need to contend directly with CPI inflation, and how does it feel to live in this environment for their voters and their citizens. And that's some of, so there's kind of two speeds on there. There's the capital base and the consuming base. And but I would say that in terms of asset prices, yeah, we're definitely in an inflationary period.
Okay. Yep. Go ahead, Shaun.
Yeah, Carsten, it's an interesting one, because I think picking up on the way that Matt responded to your first point really implies that the crystal ball is a pretty murky thing right now. And I think he was talking about scenarios or planning, and I think this year alone is a great example where, frankly, I don't look at any investments through the lens of a high level of confidence on a certain forecast. We are trying to look through different scenarios and understand what that might mean, both from a risk and a potential opportunity perspective. I agree a lot with what Matt has said, but it was quite interesting to me today. For those of you who might have picked up the Financial Times, I think the fourth most read article online on their paper was reference to a book called The Great Demographic Reversal. And the argument there is actually one for inflation with an aging population, and suggesting that the phenomenon that really has fueled this low inflation environment over the last sort of 4 decades, substantial debt, real declining rates, low inflation, and a surge of a global workforce, the rise of China, that has really helped perpetuate a lot of this, with an aging workforce seeing that pendulum starting to swing, and actually suggesting we might see inflation as high as 5 or 10% next year. Now, that's not a view that we're looking at, but I think as you then consider the world through the lens of these uncertainties, what stimulus may you see? What form might it take? How might governments react in this sort of environment? And what is the potential effect that could have on inflation? I think it's something that is important to consider versus, the old normal we're used to, which is a perennially more low inflation CPI type of environment, right?
Well, can I jump in for a second, Carsten?
Oh, please, yes.
Yeah. So, Shaun, look, I think there are a couple things from my perspective. I'd be interested in Greg's view on this that seem certain, right? So one thing that seems certain to me, as we all here we're on Minds and Money and we deal with commodities, it seems certain that the supply side dynamic in terms of the medium short-term cupboard of projects that are ready off the shelf to supply a recovering or growing world is stretched to one of the thinnest points that you've seen. So there's a huge supply side dynamic that's existed, by the way, for 10 years, but every year it gets thinner and tighter and continues to move. And so that's one thing that we're thinking about right now. The other thing that we're looking at is it also seems certain that when people are considering stimulus, they're breaking into nation blocks. So the EU is looking for its own supply base to feed its own green revolution in its own particular way. And the United States is doing the same, and you're seeing DFC and government institutions being supportive inside and outside of the United States more and more with direct support of supply intervention. And the same, of course, with China with its Belt and Road policy being accelerated. So when you get away from the macro and you pull it into the, what do you know and what is observable, I think it is hard to say exactly what 2021 looks like, but I feel comfortable saying that the supply, underinvestment in supply, that day of reckoning feels like it's getting closer and closer. And the fact that governments are now, to use a West Side Story example, it's the Jets and the Sharks, right? And you've got the Jets and the Sharks, and the Jets and the Sharks are trying to each develop their own supply chains independently, or have some amount of resilience. Those seem like very clear pieces that are signals to all of us that interact in the project development, project supply line.
I agree with what both of you said, but look, I'm not really prepared to predict inflation is coming back anytime soon. I mean, I think we've been waiting for this big inflationary environment for at least 10 years, going back to it's 12 years now, 2008, when they started to have massive fiscal stimulus to deal with the global financial crisis. And everyone was saying, well, inflation has got to be on the horizon somewhere with all this money being printed. If you just look at classic economic theory, that there's more dollars out there chasing goods and services, prices should be going up. But for some of the reasons we talked about, that just hasn't materialized. And we may be sitting here in a few years from now, with all the same dynamics we've seen, a lot of fiscal stimulus, low interest rates, lots of money around, and still going, where's the inflation? So I'm not quite sure I'd be as bold to say it's going to happen, because I think we've all been waiting for it to happen. Maybe it does at some point, but we haven't seen it yet, and we may not see it for a while.
I like the controversy, just because I think it shows the spectrum. Shaun, go ahead.
Yeah, sorry, I'm not sure I see it as controversy, because I think it wasn't that long ago, be it with different dynamics, that we did see sort of hyperinflation in the mining space that really compressed some of these margins. And I agree with Matt. I think we're all observing, particularly single asset businesses are struggling to attract the financing. We've seen, under the banner of discipline, a lot of large mining companies returning cash to shareholders, underinvestment in the project pipelines, perhaps, and certainly on the greenfield side. So I totally agree with the thesis on this point on the supply side. I just think we are dealing with a lot of uncertainty and volatility, and I think it is instructive as we think through any of these future worlds to be able to just think about, other than our perhaps base case, what might things look like if we did actually encounter things out of the ordinary compared to what we're used to perhaps for the last 3 or 4 decades.
So I like the sort of nation bloc starting to support directly their own lifestyle and supply chain strategy. I think one particular around battery metals, I'd like just to throw that in, is there a concerted China strategy control the energy chain, sort of from electricity to battery to mobile converters, getting a hold on the automotive market? For example, their investments in Indonesia for nickel laterites or the cobalt in the DRC, plus of course what earlier to Matt, the differential of pricing and buying and blocking imports from Australia. Who wants to jump on that first?
Happy to comment. I think back even 15 years ago, visiting China when I was working in the ferrochrome business, and walking away from that experience where I'd seen people with very small, seemingly sub-economic furnaces putting laterite ore through and thinking, what are they doing? Because the idea of transporting wet laterite ore, across through our economic lens didn't seem like a particularly rational thing. And it wasn't that much longer when I was in the nickel business. Suddenly we're talking about nickel pig iron versus, the part of the value chain that we'd sort of focused on. And just visiting China and just seeing the incredible amount of capital and talent that they brought to bear in terms of vertically integrating and looking at this in a very significant vertically integrated holistic manner, which when I look at the nickel space as a niche space, seeing the flood of talent out of the space, the lack of investment and the lead times needed to create some of that specialization, in the industries that I was used to. And it's continued. I mean, we've continued to see that. So I do think China has taken a very strategic view on these things and has made these investments in a very thoughtful way. We're invested in for example, as one of our investments in a small but very interesting US nickel deposit with Talon. And I look at that opportunity just so beautifully from the point of view of the regional potential, the strategic potential. And, you've got Rio Tinto as a partner in there, but that investment should really be happening now. And I do wonder with a different lens if, it would be done on a more accelerated basis with a grander vision of electrification and what this is going to mean for our various societies and economies. Because I think it's a question of time before that all happens, but it does feel like China's taking a more aggressive strategic view of that from at least my vantage point.
China typically, has longer time horizons when looking at everything. They have historically. They've got their 5-year planning cycle, and when you look at all the policy that they're talking about with respect to green energy and electrification and the promotion of electric vehicles, you just know that's the way that they're going to be going. And, we're obviously seeing that in the rest of the world. But that's obviously going to have a huge impact on demand for, these materials that go into that supply chain, whether it's copper. I think that's why people are so positive long-term on copper, on nickel, on cobalt, on lithium. So, those are the obvious winners from this big shift towards cleaner energy, green energy. So, I think you got to be positive about the demand side for all of these things. The question is, how is supply going to react? We've talked about the fact that supply has generally been constrained, whether it's by design because companies have just gotten more disciplined with their allocation of capital, or whether it's by just the environment in which mining companies are operating, that it's just that much more difficult to get anything developed. So you would assume that some things will see supply constraints. Certainly these assets that require multi-billion dollars of investments that take 10 years at a minimum to get developed. But then again, some of these markets are not that big at the end of the day. So cobalt, while the demand may be great, supply seems to be able to react fairly quickly, particularly when it comes out of jurisdictions like the Congo or Africa, where it seems to be supply can get turned on fairly quickly. So I think the demand outlook for things like that is very good. The question is how supply going to react, and I think people were a little more optimistic, maybe too optimistic about the expectation for prices of some of these things like cobalt and lithium. Supply was able to react, and that was able to cap prices, and then in most cases see them decline pretty rapidly.
Matt, you want to jump in on?
I mean,
this?
I get so excited about this. Honestly, it is. This is, for me, this is the area where the world is changing. So metals, just everybody stop for a second. Metals are now energy. And if there's one thing that we know, energy is political. And to control your own energy supply chain or have it be controlled for you is one of the great games of nations and statehoods, and how you project regional and international power. So from a pure geopolitical, does this make sense standpoint, the industry that we work in is being transformed in front of our very eyes. And what you've seen, as Greg was talking about, is a very long game of state capitalism model being played by China very successfully. And so now we're looking at a broad swath of most commodities, and certainly the 35 critical and strategic minerals that everybody's aware of, or 28, depending on where you are dominantly controlled or processed into intermediate and final goods through China, right? And each and Chinese allies, or areas that are outside of a Western bloc of influence. That is okay in a globalized world. And that is okay in a highly globalized world where everything is functioning with a certain degree. What we saw in 2020 is a world that doesn't function with a high degree of certainty. And what we are seeing in 2020 and 2021 is a world where people are going to spend a high percentage of their GDP, if they haven't already spent it, to get their economies on track. And they want those dollars to circulate within their own system to provide jobs and growth for themselves. And you've seen the emergence of more of a quasi-state capitalism from the US and from the EU. At least I've been seeing it as we're looking at project developers, we're looking at how some of these markets start to unfold. So I would say there's a couple things. One, if metals are now energy is political, and governments are now much more interested in participating in that. And you've seen that with the US Department of Defense looking at building plants for downstream processing. You've looked at it, you've seen it in Australia in terms of blocking different types of shareholders with their ability to buy or fund or finance projects, and all of those signs of this are happening all around us, where governments are much more involved in who owns what and what happens next. Turn for a second to the steel chain, and you look at the model that Japan, Korea, many of these people that they're not quite sure where their resources are going to come from, but surely they need to make steel. You see customers, traders, and nation-sponsored entities working their way through the supply chain. You have JOGMEC, who provides capital to early stage projects. You have Japanese trading companies that are locking up supply inside coal mines and iron ore mines to field their steel mills, and then you ultimately have customers that put these types of projects into production. The same thing is going to happen in energy, guys. I mean, we haven't seen it yet, but it will be Ford and GM and Tesla and BMW, Volkswagen, Toyota. You're seeing it. Some of these participations in lithium and lithium brines. You see that. That's going to happen on a broader spectrum, because if you have a world that doesn't function and it's, in a fully globalized manner, then you need to know where your supplies are coming from. If you are getting government support to offer cheaper cars to consumers, to hit your emissions targets, to create jobs, then the governments are going to want to also understand where is their ability to control that supply chain and how dependent are they on other people. So I think this is one of the great games of our time. I think it's an unstoppable force. And the only question that I have is, how fast will that play out? Is that going to play out in 2021? Or will that be playing out all the way through 2027 before it really takes hold? I think it is an unstoppable force that will impact our entire industry as we go forward.
So jumping right in there, how shall we position ourselves then? Or how should investors position themselves?
Shaun, I'm interested to see if you want to try to chop me down on that, or if you would agree.
No, actually, not chop you down at all. I tell you, it's interesting. We've gone from sort of a multilateral world. We're seeing sort of these global tensions, but even in the space of the last few weeks, we've seen a U.S. election with a seemingly an outcome. At the same time, we won't know until January whether or not you're going to have a Biden administration with more latitude to be able to follow the green agenda, which would have potentially maybe another $1 trillion or so of implication for that sort of investment that I think you're referring to, versus one where if it maintains divided, it's obviously less likely. Maybe you'll see more infrastructure spend, I think, going on from that. So I think it comes back, at least in my mind, to it's a pretty uncertain time with some pretty big numbers and forces at play here, which I don't think diminishes at all your either your enthusiasm or otherwise, because you've got this vector of an aging specialist workforce in many cases in the mining space. We haven't done a great job of attracting the next generation of talent, underinvestment in so many different areas. I think the supply side point you've made is totally bang on. But some of what we're talking about there is, you know, government forces which could have a profound impact on the demand side.
Shaun, if you have you know, and for the listeners out there, you can access the different bills online, and if you look at, for example, and there, you know, it's very visible. There's actually not a lot of surprise, and there's also very little difference. There's difference for sure, magnitude and direction, but there's a very high degree of overlap in terms of a bill from Murkowski, who's a centrist Republican, and, you know, a bill from the Democrats in terms of what they're trying to push. And it's people, talent building. It is, you know, it's educational system, workforce, you know, knowledge base, geologic domain, incentives for exploration, incentives for production, and everybody's trying to figure out, how do we do this? It's a huge knot that's all very complex, and it's one of the areas where mining companies that are positioning themselves to provide solutions for governments that are looking to create jobs, create infrastructure, and create supply chains that are resilient are clear winners, right? National champions will be clear winners because they have a surfeit of skills and political interlock. And so, you know, the thing that is interesting to me, Shaun, is that there's a tremendous amount of overlap in what everybody's looking for, because the problem is clear. You have an eroded skills base, as you said more eloquently than me, and so people are trying to address, how do we make up that lost ground of the last couple decades, and the solution ultimately is going to be through cooperative partnership, I think, between the people that can actually do it, which are the mining companies, and the either government, you know, state capitalism, and or free market, you know, public capitalism as well.
So since we talked about some of the green plan and I would call it the 2050 carbon neutrality outlook in the world, or social responsibility as an even broader topic, because clearly some of the things will with the governments being more involved, they will also drive those agendas which they have, and depending on which bloc and which country you associate to, there will be nuances in that. But before even going into the sort of the broad topic, I'd like to get any particular experience from the current COVID crisis that have helped to build community relations, because it's sort of the grassroots side of some of the things that happen, and we've seen a lot from our clients, a lot of you know, good community building, because they were sort of the rescue of last resort to actually help to provide medical support, provide PPE and other things that their own governments weren't able to deliver. So just like to get anyone's specific experience there, and any story from your investments.
Yeah, I'm happy to share a couple. You know, first, I think mining as a whole doesn't always do the best job at telling the stories of what we actually do to on frontier communities and elsewhere, and could do a better job on that, because I think also often we do a lot in those areas. And I think it's been quite evident in this crisis on some of the investments that we're involved in. One such example is with RB Plat in South Africa. You know, the Bafokeng are the majority owners, you know, very large shareholders. They've built this business really over a 10-year period. And a large part of the attraction for us was their community integration and how they actually work with the local communities. We put $100,000 a year scholarship program in there, for example, to support their efforts. But this year, you know, it's really had a big impact on their communities. And you know, part of the problem has been young learners who can't go to school early on in this pandemic. and we partner with them to. They've done a lot of frontier work with their communities, but part of that was just creating connectivity for these kids and tablets so that they have the ability to continue their learning experience. And that's not our leadership, that's their leadership. They've done an amazing job. But I think whether you're a capital provider or you're the miner, there is a part that we all have to play within that ecosystem. And we've seen similar things in Colombia with the Continental team there. They had to downscale their workforce from 9,000 to something substantially less. Couldn't get any of the expats in while they're trying to build and commission their facilities, and really a lot of concern with the local communities, as you'd expect, with rising infection rates there. And they just did a remarkable job in being able to work closely with that, respect those concerns, and to be able to support those communities. And there's other examples, but I've really been quite heartened to see how those management teams on the ground have stepped up and made a difference.
Any other sort of insights there, Greg, Matt, from your side?
Greg?
Look, I can't specifically point to the things that Shaun has talked about. Those are great examples. But look, I think one of the kind of takeaways is, as the mining industry does kind of step up in this environment and help out, it's just an important part of how they're going to have to operate their business going forward. They're already doing this. I mean, they recognize that they need a social license as much as anything, maybe more so, to operate successfully, to operate their existing operations, to build new ones. We talk about the potential for supply constraints. So I think what they've been doing in this environment to build community goodwill, to really help out, I think that's going to be an investment that will generate very good returns for them in the future.
Yep, those were some of the conversations we had with the boards in our portfolio. Were when there's pressure in the world, and certainly this is a time of pressure, everybody looks and sees how you act, and acting with consistent on-theme partnership and messaging is very important. We're a large shareholder in a company called Base Resources. Is a perfect case in point where Base operates in Kenya, a large mineral sands mine producing titanium concentrates. And look, in an area like they have a lot of advantages in terms of having hard and soft infrastructure that can be available in a time of need. Power check, water check, skilled people, light vehicles, distribution networks, all of these things that come with running a business, that when you're in a true crisis pinch point, you can react very quickly. And the mining industry is abound with stories like how on a very local and community level, you can provide support for people. And the interesting part will be, as we roll forward in time, rather than at the pinch point, but on a continued sustained basis, as communities are still figuring out how it's going, how can you provide employment, skill base, localization of supply chain, those types of things that are talked about today, in the permitting and project development basis. They have a huge importance today, and you see that unfold. The benefits of being highly localized or not really comes to light, and I think we'll all turn around in 3-4 years and look back at some of these experiences and have these wonderful examples of the common partnership you have with your stakeholders for large employers, particularly large employers in remote areas.
Very good. Then I'll sort of like to go to the broader perspective of the social responsibility. How should investors look at pronouncements by miners about 2050 carbon neutrality? What would be the impact of commodities attaining these goals?
Well, I'm happy to jump on that. I speak a lot on ESG.
Yep.
If you come back for a second to the part where I got all excited and we're talking about a world that's unfolding into nation blocks and all the rest. One of the things that is true is, particularly consumer-facing businesses are looking downwards more and more at their supply chain and looking for verifications of things like human rights, carbon abatement, and a range of anti-corruption. So some of the basic box checking that we go through, and then on and on in terms of their display and behavior of ESG factors, and then they're integrating that into their supply chain as a way to communicate to consumers their culture, their their values, and the risks in their own supply chains. And that is incredibly important, particularly if you believe, as I do, that you will see end users in some of these markets reaching down into and becoming direct participants or joining up with suppliers. How you behave and set up to communicate that to your stakeholders that include your customers will really matter in terms of opening up opportunities for lifelong, project long partnerships that will make a tremendous difference or not. And so that's, that's something for where I think you will see outsized returns continue to accrue, not from the risk management side. The risk management side is actually very poignant, and we could have a whole nother 40 minutes on that. But actually on the business opportunity side, and not from a feel good and I get to employ better people. That's all true, very valid, and the statistics prove out. But ultimately, I'm attracting partners that include my consumers and governments that will look at how I behave, what's my ESG disclosure, what's my performance and integration, and there's going to be a range of opportunities that will open up in the world that I'm envisioning, that comes off of the basis of how you perform and integrate ESG in your underlying business. And that can extend, Carsten, you asked about, how should you think about carbon abatement and 2050 carbon abatement? It's some of the same thought process, particularly when you look from a consumer through to a goods producer down to ultimately the supply chain.
Yeah, I'm going to say
Shaun?
just to add to that. Look, I think clearly investors have a very important role to play in placing the emphasis on this. But I also think in the background, technology itself is helping enable a lot of this, whereas beforehand it may have seemed more aspirational. I'll give you an example. 10 years ago, when I was in the nickel business, we had an operation up in the Canadian subarctic called Raglan, a beautiful but very remote part of Canada. Diesel gensets are the primary form of generating electricity. It's pretty expensive stuff. So from that time, it was like 28, 30 cents a kilowatt hour. And you're using Arctic diesel, low sulfur, which you have to get up on an icebreaker to get up there. All that, it takes time, effort, and money, and obviously has a substantial environmental impact. And at that point, we were looked at, even with permafrost constraints, being able to put wind in as an alternative. And it was just this year I was reading, they've done that now finally. It's in there, the marginal cost once it's in there generating this stuff, and the displacement from that sort of, that sort of carbon impact is substantial. And I think those technologies, particularly if you can crack the nuts on storage, becomes just highly compelling going forward. So I actually personally feel that you're going to see an acceleration of these targets going forward out of both a confluence of technology as well as necessity and forces by investors. I'm actually very excited about that. Even in our business being private, we know what our scope 1, 2, and 3 emissions look like, and we're working on carbon neutrality alternatives, not because we have to, but because we think it's the right thing for us to do as part of sort of this mining ecosystem.
So we're back to metals are energy and energy is political, which drives me almost to asking, within that, the earlier supply side of projects, the state capitalism, which we see the bifurcation of blocks. Do you think that, the business model in general where, people were driving for horizontal integration really is not necessarily the model which we will see in future? We're looking more into a much more vertically integrated world again, so the pendulum swinging back?
No, I don't.
Okay.
I don't. Just to be blunt, power producers are good at moving electrons around, but they're lousy coal miners. Car producers are great at building cars, but they're lousy at mining nickel, cobalt, and lithium. So, so when you think about vertical integration from mine to product, if that's what you're asking, I would say no.
But in terms of supply chain integration?
I'm maybe just taking the other side of that. I'm a bit of a fan of SpaceX and Tesla and what Elon Musk has achieved there, which is kind of intuitive to how we've looked at a lot of these things where, building a car, for example, you don't typically take in raw aluminium and build a lot of these things yourselves, and a car pops out on the other end. And I think he's made no bones of the fact that building the machine that creates the machine, the inefficiencies that have been built into our manufacturing systems are quite substantial. And I think if you build on Matt's idea earlier, where you may just see governments looking to win on this energy component, and perhaps looking at robustness of that supply chain and security of that supply chain, I'd argue you may actually see more of that type of activity. It doesn't mean that you won't get specialization within the value chain, but you may actually see a more integrated perspective being applied to improve efficiencies, drive down costs, and to be able to compete more on a global scale. It's clear that just even in manufacturing processes, there's, I think, still quite a lot of significant opportunity, and McKinsey and others have done a lot of papers, I think, on that in recent years to demonstrate the waste that we still have within our systems. So I think in a low carbon future, the more we can do to cut down on low value added transport and eliminate waste and enhance recycling, those forces, I think, are going to become more important rather than less important going forward. So that could be a catalyst for that different approach, I think.
Well, if you're talking about vertical integration being more about having a stake in the supply chain, yeah, I can see that, and you are seeing it with investments being made by companies that are going to need these new materials. And you could also, say you're seeing it in the way that places like China are operating. They're not necessarily trying to have companies that aren't in the mining industry take over the mining industry, but certainly the policy of China is to promote investment through a lot of their state-owned enterprises in the mining industry to ensure that the supply chain stays filled and there is supply. I mean, it's a good example if you look at what they've been doing in Africa around cobalt, where they've really locked up a huge amount of the supply there through their investments, and to a large extent, they're the only ones really operating there. When we talk to people about investments in that part of the world, we spend almost all of our time talking with people out of China and less Western companies, because they just don't have the appetite to go into that environment, whereas the Chinese companies do.
I think that the only area that I would disagree, so, Shaun, eloquent as always, Greg as well. The only place where I would tend to disagree is that if you have a high degree of integration with your customer, so I could see end users moving down more into creating intermediate processing facilities, because that's a pinch point in the global supply chain where the dominance of it is actually in China or in places that throw up political risk for Western interests. So you could see a reemergence of a smelting, refining, intermediate product capacity being grown outside of China just to provide alternate market routes. But ultimately, in the mining business, there's such a place for miners and mining businesses, because most people don't like to own mines. They don't understand the peculiar risks around and partnership and opportunities that you have around running extractive resource businesses, and frequently pretend that they don't exist. And so there will always be a role for miners and mining companies. I don't think that, and that's probably my only break point, is that it's a very specialized world that we deal in that will continue to be specialized, just more in cooperative partnership with the ultimate end users.
Okay.
Just to build on Matt's point, so I know we're running, but I do think the one point to build on that idea would be, I think the need for disruption, given the earlier comments about just, perhaps a vacuum of talent that we've experienced for some period, and we haven't backfilled and necessarily nurtured that. And the need for disruption in technologies. I think the ability to adapt technologies from other areas and perhaps enhance the efficiency going forward might be part of that answer. And that's a longer conversation, but it's quite clear with grades going down, the need for elimination of waste, reducing cost, and being a better part of the value chain. I think some of those could certainly be part of the solution.
And I apologize for having thrown in that last question. It was sort of one of my sort of things I thought was really interesting, but I realized I went over time here and have to wrap up. But clearly another topic to be discussed at the future panel discussion. Let me just quickly summarize. I think uncertainty, volatility is what we expect in the near term. There's clearly a supply side of projects that is thinner and tighter and continues to be that way if investment don't flow. There's more and more involvement of nation blocks to support directly their own agenda. And there's an underinvestment in talent. So those are sort of the supply side. The other, I think, good topic which came up was around energy. Is politicals, metals are energy and becoming more and more so. And we'll see more of strategy as the Chinese have played with the long game on state capitalism. But you see the US DoD becoming more excited, Australia blocking types of shareholding. So governments will move towards that, which will then also drive the overall view of the world as becoming more and more trying to enable these supply chains in a highly localized manner, and that sort of also spilled over into our conversation around social responsibility and really the long-term benefits of being highly localized, being able to help local community and work with them. And then I think finally, last piece was an outlook in terms of the commodities. Gold is forecasted to be continues to be very strong. Growth, I thought the group came up with some interesting prediction of rebound, which seems 4% to the US, Greg mentioned, and 8% in China. All of which look for a pretty good future for commodities, if I can summarize it that way. And thank you very much, Matt, Shaun, Greg, for participating. So it was a great debate, and look forward to seeing you soon again.
Always enjoyable. Thank you.
Thanks so
Thank you.
much.
That's great. Thanks.